Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph shows. We continue our credit series. Specifically now we're in part 4 of how to build better credit and how to do it the right way. And we started this discussion last time, but we're going to talk about credit bureaus. And there are really 3 main credit bureaus. And credit bureau is nothing more than sort of the keeper of the list of how well you do with managing your credit. It's kind of like Santa's list, were you good, were you naughty or nice? Well, that's what these credit bureaus do. And they maintain a database of everyone's credit history, and they package this information as reports and scores, and they sell these things to banks, landlords, employers, insurance companies, and whoever wants to buy one. For the most part, they collect similar information. So, Equifax, Experian, TransUnion, all are going to collect particular information. Now, what you will find is not all lenders report to all of the credit bureaus, and that's simply a cost-benefit analysis. For each lender to send their information to a credit bureau costs money. So you want to make sure that if you're going to work on building your credit, make sure you're looking for lenders that report to all of the major credit bureaus. And the thing you will find is that depending upon where you live geographically, one credit report may be more advantageous versus another one. I remember when I was in the credit industry, Equifax was the big player in this area. And if you got a little north, it was TransUnion. Experian now, I think they were sort of all over. But it's important that you understand where this information is going, and you need to look at your credit report at least once a year and take it out and study it and understand everything that's on there. You should know everything that's on there and make sure that information is accurate. Look for accounts that aren't yours and dispute those things. Dispute means you send an inquiry to the credit bureau and say, listen, I see you've got this loan on here, but guess what? This isn't me. And they've got a certain amount of time to return. And sometimes, things get dropped off your credit bureau because they didn't respond to it or the lender didn't respond to it. So it's important that you take a look at this. Now, one of the things I mentioned in our last session we talk about is, what are the things that do report to the credit bureaus and what are the things that don't? For the most part, major credit cards like American Express, Discover, MasterCard, Visa, they all report to the credit bureau. So those are things that are going to help you. Now, if you don't make your payments, they're going to hurt you as well. Store credit cards will. For example, Target, Gap, Kohl's. They're going to report to the credit bureaus as well. The other thing that's going to report to the credit bureaus is installment loan accounts. That would be something like, your mortgage loan or your home equity loan. It would include things like an auto loan, maybe a motorcycle loan, furniture loans. It's also going to also be your student loans as well. A lot of people don't realize that. A lot of people blow off those student loans and say, yeah, I'm going to pay those student loans off. I'll just keep them in forbearance. They don't even worry about it. Those things will hurt your credit just like everything else. So make sure that either you are making your student loan payments or you've got an arrangement made up so where you don't have to make the payments. Now, there are also some things that don't report to the credit bureaus, and that's debit cards. If you've got a debit card and that's all you use for handling all your purchases, that's not going to report to the credit bureau. So it's great to live on cash or debit, money out of your account, but it's not going to help you, build your credit. Same thing with utility and phone bills, like electric, water, cable, cell phones. Now, I want to warn you a little bit. They may not report monthly to the credit bureaus, but if you don't pay them, they are going to report to the credit bureaus with a collection. A lot of times, when I worked in the industry, we would see collections, from AT&T or from Verizon. And a lot of times the people wouldn't even know it's there. They're like, oh yeah, that was my old cell phone company. Yeah, I guess got tired of dealing with them, so I went and got a new cell phone. What they don't realize is that $175 termination fee, that utility, that cell phone company didn't just write it off. They charged it off and they reported it as a collection on your credit bureau. Same thing with rent payments. Now, one of the things that you might want to consider with a rent payment, unless your if your landlord reports to some of the credit bureaus, some of the bigger, like landlord management companies might do that. So even if you have a checking account, an apartment, and a cell phone, you might not have a credit history. One of the big things that people talk about is, why does having more credit help my credit score? And that really comes down to the simple point of it. If they can look at more things, they're going to be able to tell, are you good with your 5 C's of credit? Credit scores are funny. It sort of seems counterintuitive that someone with more credit cards is better risk than someone with just one. But don't overlook the fact that there's a little catch to this. And a lot of people don't realize this. And they get these credit cards and they use them constantly. Here's the key to this. And my wife actually is the one that brought this to my attention. So I want to give her, credit here today because she's really key to this. I mean, she honors her credit. My wife takes care of her credit. She makes sure her loans are always paid on time. I made the mistake when we first got married, sometimes sort of blowing off stuff. I'll get to that. Boy, that was a mistake. My wife honors her credit. It's one of the highest credit scores that I know of on a person. But a good credit score is earned by managing your credit well. So my wife's credit score is excellent because she manages her credit well. And one of the key things she does is this thing called debt utilization ratio. And what that means is, the best way to explain is a simple example. Let's say that you've got a credit card and they give you a credit limit of $2,000. Okay. One of the things that the credit score is going to look at is, how much of that line of credit or that credit limit are you using? So let's say, for example, you charge that up to $1,800. So you're at that, 90% utilization. Well, they're going to ding you on your credit for that because they're wondering, is something about to happen? So one of the things you want to do is try to keep that credit utilization ratio below 60%. And the easy way to do that is, use only a small percentage of your credit line. If you got to buy something bigger, then maybe you want to use 2 or 3 different credit cards and put a percentage on each one rather than dumping it all on one, pushing that credit ratio up. Pay your credit card balance down before the closing of the statement cycle. What that means is if the statement cycle ends like on the 15th of the month, you don't want to carry that balance over that, because when they report that to the credit bureau, and it's going to show, let's use our example, they're going to show the $1,800 versus the $2,000 limit. Whereas if you had made an $1,800 payment or even a $300 payment before that date, then they wouldn't report it with such a high number. And the other thing you can do is ask them to increase your credit available. If you suddenly get a new credit card with a $1,000 limit, now your total available credit card is $2,000. So in our example, if you've got that $2,000 credit limit, you say to them, hey, listen, hey, Capital One, for example, can you increase my credit limit to $5,000? Well, why do you want to do that, Mr. Estep? Well, I want to do that because I want to keep that ratio lower. So that's one of the ways to do it. It's going to help your credit score. And one of the myths about this, it's a common myth that in order to build credit, you need to carry a balance on a credit card. That is absolutely not true. The credit bureaus reward you for using a credit card and paying it off, whether you pay it off in full each month or not. So don't buy into that. And borrowing too much, especially in the beginning, will likely hurt your credit score. The worst possible scenario is for you to go out there and charge up a new credit card and then, have this high ratio. They're going to reward you for making sure you make your payments on time and not utilizing all of your credit available. So I hope this was helpful. We talked about how to build your credit the right way. In the next session, we're going to talk about some of the other ideas of credit. We're going to talk about secured loans versus unsecured loans. So make sure you join us as we continue our credit series.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.